Welcome back to Investing Talk Podcast. Today we are focusing our attention on a specialized microcap operating in the safety technology space. We are reviewing Sobr Safe, a company dedicated to non-invasive alcohol detection technology, primarily for commercial and enterprise use.
It's a fascinating corner of the market, isn't it? Combining cutting-edge tech with, well, high-stakes workplace safety. And the central question for our analysis today is crucial for anyone watching the sector. Is this stock a good time to buy now? But before we jump into the raw data and analysis, if you find value in these insights we share, please take a moment right now to subscribe, like, and drop a comment below. Seriously, it helps a lot. And hey, if you have a specific company you want us to look into next time, leave that in the comments too. We really thrive on exploring the markets alongside you.
Absolutely. Your suggestions are great. So our mission today is to cut through the noise surrounding Sobr Safe. We've pulled together the latest reports, analyst projections, market sentiment, basically everything we could find to explore its fundamental health, its market traction, and those all-important upcoming catalysts. Let's maybe start with the bullish thesis first, because, when you look at the raw revenue numbers, they are showing some pretty explosive growth. We're talking robust, accelerating top-line growth here. The trailing 12 months revenue, that's, the last 4 quarters combined, as of October 2025, hit $3,400. Now, to put that in context, that's almost double the $157,292 they reported for the entire year of 2023.
Wait, hang on. The TTM revenue essentially doubled from the previous full-year total. That's explosive, like he has said. But what's really important for our audience to understand, I think, is the quality of that revenue growth. This isn't just about selling a piece of hardware and walking away, right?
That's exactly right. If you zoom in just on Q2 2025 alone, they saw a massive 92.3% year-over-year increase. That brought quarterly revenue to 104.22 thousand passengers. And crucially, they're doing this while maintaining pretty strong gross margins, around 57.5%.
Okay, see, that margin figure points directly to the subscription model we were just hinting at. Their annual recurring revenue, or ARR, that's the steady income stream from software subscriptions, it increased by a phenomenal 109.6% year over year. That recurring revenue strength, that's what provides the operating leverage and, the stability long term. They seem to be successfully shifting into a high-margin, sticky business model.
So the idea is clients don't just buy the wristband or the detector once, they pay monthly to keep that whole safety platform running.
Yeah.
Smart. But even with that 109% ARR increase, we have to ask, is that 109% growth still coming off a very small base number? What's the ultimate validation they still need?
That's the critical check, absolutely. While the percentage growth is huge, yeah, we need to focus on the velocity of client onboarding over, say, the next year.
Right.
That'll prove if market saturation is really happening. And that velocity, it relies entirely on their competitive moat, which seems to be this non-invasive innovation.
Right. They're differentiating themselves with these patented non-invasive solutions, Sobr Check and Sobr Sure. How does the non-invasive nature of this technology, like, say, a wristband like Sobr Sure, how does that fundamentally change the adoption dynamics compared to a traditional, very visible breathalyzer, especially in sensitive spots like maybe unionized transportation settings?
Oh, it changes everything. Non-invasive tech bypasses a lot of those traditional objections to intrusive testing methods. Their patented differentiator, really, is the real-time cloud-based alert system. For safety-driven sectors, think construction, trucking, manufacturing, that instant objective data, plus the high level of accountability it brings, well, that's a unique selling point that older solutions just can't match. It really does create a genuinely high barrier to entry for any potential competitors trying to catch up.
And we're already seeing that traction build, at least domestically. Q2 saw them ship 178 of those Sobr Sure GEN2 devices, which, as you mentioned earlier, was up 35.9% sequentially just from the first quarter. That's pretty quick growth quarter over quarter.
And this traction looks like it's about to go global. If we connect this to the bigger picture, the recent intellectual property expansion is huge news. They secured a major European patent, EP4171362. Now, this isn't just, filing a patent. This is successful adjudication. That often smooths the path for national regulatory approvals in key EU markets. So yeah, that bolsters their global regulatory validation and future international prospects immensely.
Okay, that makes the fundamental growth case pretty strong. It's compelling. But now we have to confront the elephant in the room. Despite all that accelerating growth, profitability remains a serious challenge, which, is typical for a company at this stage, but still. The trailing 12 months net loss stands at a hefty negative $8.04 million.
Yeah, that net loss figure is the context we absolutely need to discuss next. They are essentially buying market share right now with R&D and marketing dollars. This kind of heavy investment, it's pretty symptomatic of emerging tech firms focused really intensely on capturing that early market share. But here's the mitigating factor, perhaps. Those losses do appear to be narrowing substantially based on projections.
How do we measure that improvement, though, if there's still burning through cash?
Well, we look at the operational health metrics. The focus really has to be on maximizing EBIT margin improvement, that's earnings before interest and taxes. This metric is useful because it strips out things like the massive non-cash depreciation from their R&D spend. It gives us a clearer view of the sort of true health of the core operations. Analyst consensus forecasts for the full year 2024 earnings per share, the EPS, is currently sitting around $0.27. Now, that suggests the losses are indeed shortening compared to the total 2024 losses of $10.56 million. So the path is getting shorter, but it's definitely still uphill.
Speaking of uphill, that Magnate $8.04 million loss is driven by that elevated R&D and marketing investment needed to scale the product and, get it through all the regulatory hoops. This means they are definitely in cash burn mode, no question.
And this brings us right to the single most important company-specific risk: execution risk. Plain and simple. Management needs to prove they can scale sales aggressively and transition from just being a promising technology firm to a scalable commercial operation efficiently. They absolutely must get control of those operational losses before they need further capital or face really painful equity dilution. That's the real test here. Operations.
Okay. Now, when we look at the balance sheet health itself, the source material notes they have a, modest market cap, around $5.19 million. They've got 1.52 million shares outstanding. And importantly, they have low debt levels, which usually provides operational flexibility.
Wait, I want to maybe push back on that notion of low debt being purely positive here. For a microcap that's relying on speculative growth and high R&D spend, isn't low debt possibly just a sign they haven't managed to find significant non-dilutive funding yet? I mean, isn't their reliance on equity dilution, which we just identified as the key execution risk, potentially more dangerous in the long run than having some modest manageable debt on the books?
That's a really fair point. Low debt means they haven't mortgaged the future, sure, but it also cranks up the pressure on management to execute perfectly and quickly to avoid diluting current shareholders even further.
Exactly. And just as a final point on the risk side, as a microcap, the stock is inherently sensitive to broader market and sector shocks. Even though the source material notes a surprisingly low beta of 0.03, suggesting maybe some immunity to broad market swings, liquidity and volatility can still fluctuate really sharply. As market enthusiasm for this kind of tech cools off, microcaps often feel the pain first and fastest.
Okay, let's pivot then. Let's look at what the chart watchers are seeing. Moving into the technical picture. Given this aggressive spending profile and the high-stakes execution needed, are the charts telling us whether the market actually believes this bet is paying off right now?
Well, the current trading range is somewhere between $3.31 and $3.59. That's actually a pretty strong recovery from the recent lows we saw down near $2.41. Technically speaking, key support seems to reside near that $3.30 level, while short-term resistance is noted right up at $3.59. Pretty tight range.
And where are we sitting relative to the longer-term trends? Are we above or below those key moving averages?
Cautiously optimistic, I'd say, based on the averages. If you look, the stock is trading slightly above its 200-day moving average. That's kind of the long-term trend line, which is sitting down at $2.56. However, it's still trading slightly below the 50-day simple moving average, or SMA, which represents the shorter-term trend. That's currently at $3.43.
Okay, so sustaining a move above that $3.43 level would be a key signal, wouldn't it? It would suggest the short-term trend is catching up to the longer-term optimism, potentially setting up a more bullish run.
Precisely. And the momentum indicators are also leaning positive, or at least neutral to positive. The 14-day RSI, the Relative Strength Index, is sitting around 46.76. That's pretty neutral, maybe leaning slightly bullish. And the MED signal, which tracks momentum changes, is positive. So that suggests continued upward trajectory is possible if volumes step up to confirm the move.
And sentiment seems to align pretty well with this technical setup, doesn't it? Externally, market optimism appears to be growing. We're seeing analyst loss estimates being sharply reduced for 2024, signaling confidence in that path to profitability. And there's clearly positive chatter and engagement happening in the retail investor forums online.
Yeah, but what's really fascinating here, potentially more significant than the retail buzz, is the possible signal of smart money accumulation that some chart patterns might be suggesting on the daily charts. Now, this isn't just retail chatter. We're talking about subtle signs, maybe unusual block trades, perhaps increases in dark pool volume, things that could suggest institutional investors might be quietly building positions. Often, they do this anticipating some future commercial success or maybe even an M&A event down the road. That kind of accumulation, if it's real, is a potentially powerful indicator of structural upside, especially given their tiny market cap.
Okay, so let's talk timeline then. Investors always want dates. What catalysts are coming up in the next, say, 0 to 3 months that could actually move this stock and potentially confirm that smart money thesis? Well, we have two fixed dates to keep an eye on right away. First, the Q3 2025 earnings report is expected around November 6, 2025. Investors will be absolutely laser-focused on continued revenue growth, obviously, and crucially, whether they can further narrow those operational losses. Second, the company is scheduled to present at the Gateway Conference on September 3rd, 2025. That's a critical opportunity for them to drive awareness among professional investors, maybe VCs too.
Right. And beyond those fixed dates, we also need to watch for market structure events in the short term. Potential institutional 13F filings are expected out in early October 2025. Those will reveal if any major funds have actually established or increased positions during Q3. And we also have the Q3 S&P ETF rebalancing review coming up in late September 2025. Now, given their microcap status, any potential inclusion in relevant small cap or tech ETFs could significantly impact liquidity and trading volume. Something to watch.
Okay, good points. Looking beyond just the next quarter, then, what are the longer-term drivers that support this stock and maybe justify that bullish 8 out of 10 rating you mentioned?
It really comes down to two major tailwinds, I think: regulation and geography. First, we are seeing increasing regulation around workplace and even school safety, specifically regarding alcohol detection pretty much globally. This trend is creating mandatory multi-industry demand that directly benefits SOBR Safe's patented non-invasive approach. Second, on the geographic front, they are now positioned to leverage that new European patent we discussed. Plus, they've initiated early testing in markets like India and Italy. That shows real ambition for potentially rapid international product adoption, especially where safety standards are evolving quickly.
Okay, now for the really interesting part. The high-risk, high-reward speculative buzz. These are the unconfirmed market rumors floating around that, if any of them materialize, could substantially accelerate growth and potentially give us that, rocket ship scenario investors sometimes look for in microcaps. So the chatter includes things like a potential large healthcare or insurance partnership announcement. The idea being they could leverage the detection platform for broad wellness programs or maybe insurance premium reduction initiatives. There's also persistent buzz about accelerated M&A interest rumors that larger security firms or diagnostics companies might be looking to acquire next-gen alcohol monitoring IP, like SOBR Safe's tech, to expand their own offerings.
Exactly. And we also hear whispers about negotiations for participation in municipal or maybe Department of Transportation contractor pilot programs. Look, rumors are just rumors until they're confirmed, right? But given the very small market cap here and the technological advantage they seem to possess, any materialization of these kinds of deals could lead to really significant short-term momentum and potentially massive valuation shifts. That's the speculative hook, that potential catalyst that we're all watching for. So bringing this all together, kind of synthesizing the analysis, we land on an overall bullish rating of 8 out of 10. The rationale is pretty firmly based on that combination of accelerating recurring revenue growth, the depth of their product innovation, and the patent protection they have, plus their strong industry positioning, which seems driven by these almost inevitable regulatory tailwinds.
So this potentially makes SOBR Safe compelling for maybe two different types of investors, doesn't it? You've got those interested in shorter-term trading, maybe looking to leverage those imminent earnings reports or potential partnership catalysts. And then you have those looking for a longer-term investment, aiming to capture the broader sector tailwinds and maybe even hold out for a potential M&A premium down the line. Okay, that brings us to our final provocative thought for you, the listener, to consider as you do your own research on this company further. If global regulatory bodies do continue to favor non-invasive monitoring for workplace safety, how quickly could SOBR Safe's high-margin subscription model actually scale internationally, especially leveraging that new European patent? And, maybe more importantly, what impact would that kind of massive structural scaling have on their current, very low $5 million valuation?
Yep.
Something to think about.